Hello everyone, welcome back to the Monopolistic Investor, and this time we'll be taking a look at what happened during the past week ending June 17, 2025. First of all, we'll take a look at the Iran-Israel conflict and the potential upside-seeking companies, and why looking at these news from that perspective can be wrong in terms of looking at companies which will profit from that. As an added bonus, we will take a look at why I sold all of Altria and instead bought Adobe. This is a major change to my portfolio, and it's actually one of the few sells that I have done, and instead transferring to a different position altogether. So this will be an interesting episode. Let's start off with a big disclaimer. This isn't financial advice. Please don't copy me blindly. Do your own research and contact a professional advisor that will help you invest. So, first of all, let's take a look at the differences between Adobe and Altria. Of course, Adobe is a software company that develops the software, for example, like Photoshop, Adobe Creative Cloud, which includes a suite of other products such as Adobe Illustrator, Adobe Audio Enhancer, Adobe Acrobat. You can edit PDFs, you can basically do many things. Premiere Pro, edit YouTube videos professionally. You know, it's a gigantic amount of products. Whereas Altria is a company that sells cigarettes in the US, and they are a company that had spun off Philip Morris International in 2008, and Philip Morris actually outgrew the parent company Altria. So right now Altria is the biggest player in the US in terms of cigarettes. They own Philip Morris USA. And so a bit of a trouble arose recently, and I will go into why I sold them in just a second. Now, why I bought Adobe. Steady increase in their financial performance. Their revenue growth is just astonishing. I will go into that in a second. How it looks like exactly, but the revenue is much more predictable than Altria's one. I will show you the comparison in a second. Potential. The promising opportunities for future success. Adobe is a software company, much less dependent on physical items that, for example, Altria has to sell or to keep stock of. So they have to keep shelves with some items in their warehouses and then ship them, sell, all of that stuff. Well, Adobe is a software company, so they don't have that problems. Even though I invest in other companies which are a bit like Altria in that sense that they sell physical products, they are in a different industry. What's worrying me is that Altria is very much dependent on traditional cigarettes, and I will go into that in a second. As you know, Adobe is a software company, and so it's less risky for me personally to invest in such a company which produces software and not which produces smoking goods. Why? Well, because smoking goods are under huge regulatory scrutiny, and that can be a bit, make the company sluggish. But now let's turn back to the revenue growth of Adobe, and let me just highlight it here. That was yesterday. You can see it dropped in price. I will go into that, why it went down and what I think of it. Adobe has really strong revenue growth. You can see quarter over quarter here. this is year-over-year growth, but you can see that quarter-over-quarter they are growing steadily in their revenue, steadily increasing their financially efficiency. They have revenue growth year-over-year of 10 to 11%, pretty stable if you ask me. Now, if we take a look at Altria, it's a different story altogether. For the past 5 years, their revenue has basically just stayed in one place. As you can see, they have periods of more demand and less demand, but generally it is a sideways trend, which isn't something that I like. As an investor, if the stock price has a sideways trend, that's not a problem. But the problem comes when the revenue is a sideways trend. It doesn't go up. It stays in one place, or even worse, it goes down. As you can see, their revenue is pretty choppy, their revenue growth is pretty choppy. Even though they might be increasing the efficiency of their business on a quarterly basis, they have net profit margin of 50%, they are still not growing their bottom line, their revenue. This is really not good. And so here, I also made, this is part of my market vision software which I myself developed, and it's available if you sign up to my paid Substack, or you can just pay for the software. It's 30 days free trial in the description and pinned comment. This is their financial health shown in an easy to understand way. As you can see here, Adobe has positive net equity and positive cash. So they have more cash than debt, they have more assets than liabilities, a poster child of a perfect financially stable company. But here we have Altria. Now, I must confess, I haven't done enough research on Altria and their revenue, hence why I am selling it. I am not selling because I'm pressured to do so, I'm selling because I understand now that I have made a mistake and that it wasn't the best investment. Maybe I thought so at the time, but it isn't a company which I believe has so much upside left, in my view. Here you can see Altria has negative net equity and it also has more debt than cash, as you can see here. This is proportional to each other, but this isn't proportional to this. So this might not, be proportional in and of to themselves, but you can believe me, this is proportional because you can see this minus this is equal to that. I will need to fix it at some point so that it will be proportional, because it will be a better illustration of the finances. But nevertheless, we can clearly see the stark difference between the two companies. It's gigantic. Hence why I had to sell entirely out of Altria. That is one of the reasons. Another important aspect, which, is a bit of a disappointment for me, is actually that Adobe has a new competitor, namely audioenhancer.ai, a new browser-based application which announced yesterday the official launch of their free audio enhancer platform, designed to help users achieve studio quality voice recordings with ease. And it's, in their words, is a powerful, accessible alternative to Adobe Podcast Studio without any software installation or subscription fees. Now, we can see here that it's basically free. It's a single upload, and the platform removes the background noise, enhances voice clarity, and balances audio levels to deliver high quality sound. Users are happy, but shareholders, as you can see on the slides here, that was yesterday, but it's not a good thing to happen to Adobe. Of course, this brings on to many challenges. How will Adobe react to that? How will their customers react? Will they mass cancel and switch over to a different platform, or will they stay and be loyal customers? Now that is a different question altogether. I myself haven't really thought much about this. I am a bit worried that if some very specific niche startups might go in after some industry, for example video editing, they might clear out Adobe out of that, although I'm not so sure of that, as it is already a high barrier to entry and people like YouTubers might buy a package of a few different softwares at the same time. So you have Illustrator, Photoshop, Premiere Pro all in one go. So I'm not that worried. For now, it needs to be watched definitely by many people. And how did the trade look? How it happened? So I sold 4 shares of Altria for $239.16. I then converted this money into euros because I can only buy in euros on this trading 2-1-2 account. I will sell my whole account probably during October because I will turn 18 and so will be able to buy shares on my own account. This is with my dad's account. And so I received €206.81. Now, I didn't buy only Adobe, I also bought ASML. And of course, this video isn't about ASML, but let me just tell you that I'm very, very bullish on ASML, as I currently believe that this company is the leader in terms of ultra like high, like really strong ultraviolet radiation machines, which are used for lithography. They emit ultraviolet light, which is so thin that it's actually only slightly above the X-ray rays. So ASML has perfected its technology, the limits, and every time I analyze this company, I come to the same conclusion. They are a monopoly, which is basically what I invest in. I invest in monopolies. That's why I invested in Altria originally, but now I have finally seen the cracks in their business and learned that sometimes selling a company doesn't mean you are not a value investor anymore, because I used to think that I should buy and hold and never sell. Well, that is true, but you should sell, in my opinion at least, when it doesn't meet your investment goals. But some people take an emotional approach and sell when they will lose everything. So don't take this as financial advice, please. I bought Adobe shares, 0.5 of them exactly, for €190.06. ASML, 0.02 shares for €16.52. Modest position, but remember, I will show you my portfolio in a second. It's only a part of my portfolio. So going next, now the ultimate reason for why I sold Altria. It hasn't been an easy decision, to tell you the truth. The selling itself is a simple click of a button. It was gone after 1 second. I got the money back. I earned 14%, but what is the whole reasoning behind it? That's what I'm trying to tell you. Well, first of all, revenue growth is stagnating. It has been on a downward spiral, as you could see from the slides before. It's going up, down, but basically stagnating, similar to how Apple works. Now, their very high dependency on traditional cigarettes might mean that in the future they might get, maybe not completely pushed over, but the e-vapes, which are becoming increasingly popular, could take some market share from there. Although, I strongly believe that this company still will offer a high dividend yield that is growing 4% on an annual basis, the dividend. I myself think that it doesn't offer as much upside as I want. If that company is buying back shares but the revenue is stagnating, and they seem to be late to the game, their child company, Philip Morris International, is doing pretty great job with their Zyn brand and other stuff. I personally believe that Altria is a bit of a slow company to react, even though it has a huge market share in the US, which is essentially a monopoly for them. It's not as high of a quality investment as I would like it to be. And that involves stress. The emotional layer in investing is always present. That doesn't mean I panic sell or FOMO buy. It means that I need to sleep peacefully at night knowing that my shares are relatively safe. Of course, it's risky, but I need to have a bit of a peace of mind with my investments. Now, what I mean by stress? Well, for example, look, they are in the cigarettes category, and while the e-vapes are getting more FDA approval, I think, the traditional cigarettes continue to receive backlash from many people. I personally have never smoked and I never want to, but people are still, turning against, I think, traditional cigarettes. At least that's what my impression is. Those e-vapes are becoming increasingly popular, even here in Poland, where Altria doesn't operate. So I myself think that Altria is a bit late to the game. But if we take a look at their valuation, it's a bit more nuanced, Here, this is also from my website, Market Vision. This is the varied cash flow valuation. Now, why varied? Well, because on a year-over-year basis, the amount that the cash flow goes can be different. And while traditional discounted cash flows assume a steady growth rate of something like 8% or 10%, I took a different approach and instead made more varied revenue growth rates so that it will be more reflectable of the real world. Of course, I don't know when it's going to go up or down, but it's just my assumption, and based purely on that, if we assume revenue growth rates of around 9, 8, 6, 7, 8%, current numbers are here, projections, you can see on a year 8 basis, we get to an intrinsic value of 407. Of course, it depends on the factors you put in. I went in a little bit more conservative, but you can see that even with a conservative scenario, I still get a little bit of margin of safety. That is great. Other combinations result in 480. It depends on your combinations. But Altria is a different thing altogether. Even when I assume a negative revenue growth rate of 3%, 1.3, 1.3 minus percent, and then a bit of a positive 1.4%, and then 2% growth rates. As you can see, on a 5-year basis, they are undervalued. $100 intrinsic share price value. So that accounts to around 70% of upside for this company. Now, of course, this is only my view. It doesn't have to be true. But it just shows you that there's a lot of expectations baked into Adobe rather than Altria. Although we need to think about it because, well, it's going down all the time. But basically, I think that for the next 10 years they'll continue as ever. Of course, I'm not sure. Take it as you wish. Now we'll talk about how different industries might be impacted by the Iran-Israel war. So, first of all, the companies that are going to profit the most from this situation are the likes of Chevron, so oil and gas, Lockheed Martin, a company developing military solutions in the US, and Raytheon Technologies, the provider of Patriot missiles systems. That is one thing. Those are the companies which, based purely on the Iran-Israeli war, they could see some upside. And so people might view them as less risky of bets, as they will have government contracts, and governments are usually really sound in terms of paying to their clients. So that is one thing, but there is another side. What about the companies like Walmart, McDonald's or Apple, the consumer companies, which in times of war can be seen as unnecessary maybe? Well, I personally believe that it's not the stock's volatility, but something totally different that defies its risk. We've been told that volatility is risk, but if we focus on the long-term growth trends of companies, those short-term movements aren't going to impact us as it would be before. So we should know that volatility isn't risk. Why? Well, for example, many famous investors such as Peter Lynch and Charlie Munger debated on that, and they came to a conclusion that actually you should embrace risk. Volatility. Volatility should be embraced because it's not the same. Because it makes you test it whether you really have invested in this company for a reason or just gambled it away. Why? Well, because volatility allows you to take advantage of that. And a good example of that is a roller coaster. And many roller coasters are wild rides, anyone knows that. But all of them have to be equipped with safety bars. So let's assume a volatile investment. Well, it's a roller coaster which looks like this, but it has the safety bars, so you won't fall down. And while it is a very dynamic ride, it has a safety standard. So you could think of it like the balance sheet of a company, or high profit margins, or revenue growth which is predictable, recurring revenue, or really stable clients such as government contracts, or you could also take a look at their monopolistic position. Now, a less volatile investment, well, you can imagine a child's roller coaster, which is really simple, one track, maybe one loop, but nothing special. But guess what? Even though it may be a slow ride, it has no safety standards, without any bars. So when you go on this loop, you fall down and maybe be injured. So, it depends on your view. Volatility can be compared to as a very dynamic ride. I'm not saying that every company which is volatile is has some safety margin. No, it doesn't have to be the case. But from what I'm seeing is that many companies such as Intuit, which are good portfolio like performing companies, well, they are very volatile, but over the long term it doesn't really matter. We shouldn't be using companies purely because of the current world situation as an investment. We shouldn't think that investing in military stocks is less risky than investing in consumer defensive during times of war. Well, because who will buy Apple iPhones during war? Or who will buy this expensive Happy Meal at McDonald's? Well, guess what? Volatility always happens. But another fact is that over time, markets tend to continue upwards because the economy grows. And if the economy grows, so do your investments. I think that's how it works. At least that's my view. This isn't financial advice. Remember, this isn't financial advice. Now, so you can see my view on all of that. But that's not the end, my dear friends. We'll take a look at my trading 212 Pi. You can see my holdings changed. I don't have Altria. And my biggest position is Adobe at 384 euros. And my second largest is Google. We're at 260 and ASML at 236. Uber has 233 euros. And the next one is Caterpillar at 203. And the rest are smaller positions, although still meaningful. Here is this Intuit I mentioned. It can be very volatile. 1 year. It may look like this. Oh, you were lucky to buy here. Well, look at this. It can go up, down, very, very, very up. It has a very high beta, and it's not something which many people enjoy, but it's something you need to think about when you're an investor. So right now, I continue to believe in Adobe. Right now, it is selling off. People are commenting whether it's a good company or not. I personally think it is a good company, and that's why I invested in it. So, based purely on that information, I'm not buying any more of Adobe at the moment, as I don't have money to invest. View it as a good investment for me. Now, I want to thank you very much for your attention, and remember one thing: stay monopolistic.